I know you've gotten, many of you have gotten my mails, but I don't know if you usually read them and check the details I send. But Liam he maybe doesn't like it when I say veteran, but he's he's a veteran in the financial modeling space. He is the founder of some products, and for those who have attended my training, you will have heard me talk about some product that some product is such a big formula that the company decided to start and name themselves some product. That's how much it is in terms of value and how huge the kind of things you can do with some product. So that is his company. So in case you've heard me say that, this is the Liam in person, and he's been in financial modeling space, and which Excel is the big tool in financial modeling. So I guess that's why he picked the name some product. And he's been in this space for over 30 years. He also has been to Nigeria, which you get to learn something about his experience here later on. And since he's here, I would not want to take too much time trying to read his profile again to us, but I am assuring you it's a big pleasure for us to have him join us. I would have said maybe it's a pleasure that he's been in Nigeria for the first time, but no, he has not. This is not his first time presenting to Nigerians. So let's just say this is a nice time to have him show up in our space again. So Leah, thanks for joining. And
hello.
Okay. So we have, because of the nature of the uniqueness of today's session. Where's your window shared? So I just want to check something with the recording. Okay, yeah, it's going on great. So we normally do ask people, our special guests, 3 questions at the end, but in your own case, we're going to ask you at the start because we want you to go take a rest. So we want to ask you, can you tell us about your journey, how you came into this space of financial modeling? And even I would like to hear about the starting of the company, some product, and why that name. That's something I would really like to hear.
Okay. So I started off many years ago actually as a maths lecturer of all things. So my background is probability, and I was a university lecturer to begin with. And my old girlfriend said to me, "You make much more money as an accountant than you will as a lecturer," and she was absolutely right. Although I sort of hated it. But I ended up getting into accounting and was doing work in mergers and acquisitions and valuations and things like this. And I had people building models for me. And invariably, they were always wrong and had lots of mistakes. And I ended up rebuilding them myself. And I ended up getting a reputation for being a good modeler and got stuck with, well, Liam can do it. And that wasn't really how I wanted to actually have my career, but that was sort of what happened. And it's like, to quote Al Pacino in Godfather 3, it says, every time I tried to get out, they pull me back in. And it was a case of that was the worst Al Pacino impersonation you've ever heard. But it was a case of I got stuck in it, and I sort of presented to other people how to do it, and over years I've sort of realized you can make it simpler and simpler and simpler, and that's why I wrote the books I did, to sort of show it's really something that you just leave your brain at the door when you're building a model, because it's a very simple way of building it so that your balance sheets will balance. I mean, to answer the other question about some products and things like this, it's like there's a flippant answer and there's the correct answer. The flippant answer is, I like to go to America. They say, "What do you do?" And I say, I sell some product, and then I get taken down to Guantanamo Bay. But that's not the real answer. The real answer is that I use lots of different functions, and it's funny, when I first became an MVP, a lot of people knew who I was, because the first article I ever wrote was "Those who can do, those who can't use VBA," which went down like a lead balloon with the fraternity. A lot of people were real VBA gurus, and I always used to try and do everything to avoid it. But the second article I wrote was actually, and again, tongue firmly placed in cheek, as it was with the first one. If you know me at all, you know I've got a devilish sense of humour. It is the fact that I had this point of, I said, I reckon I could build a model just using the sum product function and no other function, because it is such a versatile function. And it is, in the early days, I used to show all these different things you could do with it, about counting unique items, doing the equivalent of multiple criteria analysis, and all these things that appeared impossible before the realms of dynamic arrays. And I was so enamored by it, that's why I called our company Sum Product. That plus it wasn't $5,000 to buy on Google, so it was a case of it was a nice cheap investment. But yeah, it's that Sum Product and offset are probably my two favorite functions in Excel. They both have their strengths and weaknesses. I'm not saying either of them are perfect, but they're very versatile, and it's a case of, I think you have to be in this day and age. I try to be too. And I'd like to point out that having spent over nearly a third of a century actually modelling, I started when I was minus 12.
That's a very interesting one. And so the second question we like to ask, then welcome to everybody who has joined recently. You can also ask questions, because at this point, one of quickly asking, unfortunately, the questions you might ask might not be related to the session yet, because you've not gone through the session. But please, in case I see some people who, I'm sure it's because of your profile that they've joined. I've not seen them join my meeting before, so I'm sure maybe they even have a personal question they would like to ask you. So you can't.
Perhaps I owe them money.
No, I don't think so. Okay, so the second question is for people starting out. Like for me, I'm new in this space. All of my, I'm just lucky that I got the MVP, and I'm sure it's because there's not so many people aiming to get it in Nigeria when I tried. So it has nothing to do with years of experience. I guess just to encourage the community here was why they gave it to me about 7 years ago. But financial modeling, even the whole working space, I know I'm relatively young, and financial modeling just about 5 years experience in it. What will you advise for someone even younger, say maybe someone just trying to get in, and those of us who are just say like 6 years, 5 years in it? And when I say what's your advice in terms of how even the old space is changing, or how it wouldn't change, because almost every year we keep hearing about, oh, it's going to be automated, or Excel will no longer be the tool, or I know you are a bit more aware, or a lot more aware of where the future is going to lie, and we want to hear your own advice and opinion about all of these. Yes.
I think for the last 20 years, I've had salespeople come to me many times telling me that Excel is on its last legs and their software is going to replace it and are moving on, and it's never happened. And of course, there may be a piece of software that does actually do it at some point, but Excel is like one of the most popular pieces of software in the world. It's very, very user friendly, and it's very easy to pick up financial modeling. And I would say that if you are actually looking at building models and understanding financial modeling, it's a case of it's not about going and joining this institute or that institute, and there's various institutes out there that offer these services. I think it's about having an inquisitive mind and being logical about it, and looking that whatever view you take about what the best practice principles are, it boils down to the same 4 things, which is what we put on our website. And I've been involved in putting together best practice principles for many different institutes and companies, and it's really about make sure whatever you do is consistent. Make sure whatever you do you've checked so that it's robust. Make sure that you don't put any hard code in there so it's flexible, and make sure that people can understand it. It's transparent, and it's as simple as that in a nutshell. Consistency, robustness, flexibility, and transparency. Going forward, I think it's interesting. One of the things, I'm not trying to market this, and I'd be more than happy to come back and do a presentation on this at a later date. And I know we haven't discussed this, oh my God, what's he going to say? Is I'm actually up in Sydney this week recording a new series of videos that we're doing for financial modelling in Power BI. And I think this is a world first. And let me just be clear, there's people out there claim they're doing this. They're not. What they're doing is they're building financial models and then they're importing them into Power BI and then they're visualizing them and using the power of that. And that's brilliant. That's very good as well. I'm not saying. What I'm suggesting is building the model in Power BI. Then you could actually build three-way integrated financial statements down at the customer level, the brand level, whatever you've got, as long as you've got the granularity of detail. Imagine the power of that, especially in a COVID world, especially when everybody's not quite sure what times we're in. It's quite tumultuous at the moment. But, you know, the whole video here on being cash flow is queen, as I say. This whole point here is that will be really powerful if you can slice and dice it to see where your key drivers are, where your main areas of value are, and where it's destroying value. And I'm saying it's not easy at the moment, but I think if people invest some time and look at perhaps doing this in Power BI as well as Excel, not as a replacement, but as well as, because Excel is still more versatile. DAX is not a Turing complete language. I'm sure you've had people here talking about lets and lambdas and things like that, which has now made Excel Turing complete. Excel's got Power BI beaten on that. It has, but it can't slice and dice it like Power BI can. It can't visualize it. So I think the two go hand in hand. So I'm not saying one's a replacement for the other, but I think they complement each other. And I would say that if you're looking to get in, nobody knows how to do this at the moment in terms of, I mean, other than us, we're trying to tell the world as it is here. And I think, there's no disadvantage to being a newbie. So I would go in with an open mind. I don't think it's replacing Excel. It's not. It's enhancing it.
Great. Maybe one other thing I'll ask about what you've just said about Power BI for the.
Yeah.
Do you think it can do the forecast side, the predictive side of the financial modeling, the forecast?
A little bit. I mean, where you get it going with that is with the line charts. You've got the forecasting tool in Power BI, and you can go down there a little bit, and you can also parameterize some of the inputs and put scenario and sensitivity tables in there. And at the moment, I think, unless somebody's got some other clever idea, you could write functions and sort of start building your own correlation matrices and doing linear regression. But again, I think this is where it sits side by side with Excel, and perhaps you take your data from one and then put it back into the other for the time being. I mean, let's be honest. I do a monthly newsletter. The monthly newsletter for March had 50 updates on Power BI. It's a case of they're going crazy on it at the moment, and there'll be more and more things coming up. Some of them, yes, we know about already, which we can't say, and some we don't, and they're just as much a surprise to us as anybody. And the fact is that it's exciting times that this is such an immature product that if people clamour and say we want this, Microsoft will listen. Go to user voice. And say you want these things, but you can make it go so far by plotting line charts and then using the forecast tool. You can get so far with it. It's not as powerful as Excel. It's not as powerful as Minitab and all the other software. Well, Minitab showing my age here. Sorry, the more the later functions, the actual software from the last 20 years, shall we say? I think I have to. Hello, I'm just going to take my shoe off for a minute and just so I can shoot myself in the foot fully. That will be my view. That I think it's not there yet, but you can do some stuff on it.
Okay. So anybody has a question for him? Any questions? Okay. So if no questions, I'm gonna just sneak in one last one, and then we go live into the session, and I'll kick Liam out. So he needs to go take a rest. So, the last question, which is cheating, because I said I was going to ask 3, and I think I've exhausted it.
That's all right. Don't worry.
Okay, so there's so much about, again, for someone who is a bit new into the space, so what I'm saying is relative to my own experience, there's a lot more talk about the corporate financial model. Like there's a lot more people who have expertise in it, and even some people who are not aware of the project finance model, that there is a project finance model. And I think there are fewer resources too in that space. Pretty much anytime people search online for resources for financial modeling, it's always the corporate finance model that comes up. What do you think? Well, from your wealth of experience, what is it that is not so well known about the two?
It's a subset, and I think it's reflected as a result that it's more of a niche area. So project finance, for those that don't know, is basically a project where the money raised is then paid back from the supposed profits of the actual project. So it's really just a subset of a corporate finance model, building a valuation, and so you don't just have the three-way integrated financial statements. You model in more detail the whole cash flow. What they call it is a kind of like a funding cash flow, where you change the order. So if you're building a normal financial model, cash flow statement will. Most modelers will try and do an indirect one because they'll start with the P&L and then they'll make adjustments. If they follow what I do, and you can please go on our website, someproduct.com. It's completely free. I'm not trying to do a sales pitch here. It's free. You will see on there we advocate about using the direct basis, because the fact is then you can use what's called a control account, and it makes it easier. And we talk about that a little bit in the video that's coming up. And the fact is that what you're looking at doing is going from the statutory cash flow statement, whether it's direct or indirect, to building a free cash flow with the debt financing in greater detail and in order. So if you've got mezzanine finance, if you've got junior debt and senior debt, you need to pay it back in the right order. And these are things that people don't bother with normally, because for most people they're just thinking, yeah, I've got some debt, I've got some equity, that's the end of it. It's when with project finance you're thinking about, I've got to pay this back in this order, have I got the money to do this? And you'll see that if for instance, if you're on there, Michael, if you go to the thought page on there, if you just click on the thought tab up at the top, you'll see you don't need to log in. It's the two more to the right, there's thought.
1, 2, 3.
There you go. Thought. And when it goes to the thought page, these are lots of articles we've written. Everything on here, as long as you stay away from the subscription page, is completely free. And there are a whole load of actual Excel files you can download. And if you just type in the search box, don't press enter, but just type in debt. You'll see in here we've got debt sculpting, the second one. This actually talks about what's the amount of debt you should pay each year in order to keep your financing at the right sort of level without using macros. And it goes through in quite a bit of detail, and there is an Excel file you can download. So you can see that it that's all, got the white screen of death, or has it gone off screen? But you'll see when the page comes up, it talks about debt service coverage ratio, the project life and loan life, and I explain it from first principles in there, because it's something that you're quite right. You don't find much of it out there, because of the fact it's just a niche subset of financial modelling, and I think that's why it's there. The other one is valuations in general. A lot of people who build valuation models get it wrong because they don't put the right cash flows into the cash flow statement. But that's a subject for another time. I think it gets quite technical, and when I present to valuation groups, most of them can't do it right. And I'm happy to say that recorded on for the record, because they'll know.
So thanks a lot, and I think at this point we have to let you go. So
no, can I just say one thing before I disappear?
Okay.
I probably won't be on at the end, but if anyone does have any questions and think afterwards, feel free to either leave them with Michael or email me directly. It's fine. I promise I will get back to you about them by email at a later point. So I promise I don't get many friendly emails. They're all like, give me my money or something like that. But the fact is I'm happy to answer questions, and hopefully at some point I'll be back in Nigeria.
Yeah. Without any explosion happening.
Yes. As the video will explain.
So thank you very much. So we are
No
going
worries.
into the
Pleasure.
session. Yes. Okay, so he's prepared for us the session, and he's been driving for the last 18 or so hours, so he has to go take a rest. Okay.
Hello, my name's Liam Bastick, and I'm an alcohol. Oh no, that's the wrong group. Hello, my name's Liam Bastick, and I'd like to thank Michael Olafusi for inviting me along to this Nigerian financial modelling community event, where I'm going to be presenting on cash modelling tips. First of all, I would like to thank Michael for referring to me as the veteran financial modeller. Always sounds good that I must be getting old and past it, so thanks for that very much, Michael. Do appreciate it. I'll see you later, mate. Actually, I know this is going out to places other than just Nigeria here, but I do miss traveling, and I have been to Nigeria a few times. I've been doing some training over there. So in particular, I remember that very long bridge from the airport into central, I think Lagos, however you pronounce it. But I will tell you a quick story. I will always remember one particular trip to Nigeria. I was presenting for an investment bank over there, and I'd finished, and I was staying at the hotel, and I was doing some work. And as a trainer that travels, I have two laptops with me. It's just in case one falls over. And I had them both on a kitchen table in this apartment, and I was doing some work, and I just nipped off to go to the toilet. And while that happened, the fridge in the actual room exploded, and the door shut off and hit and took out both my laptops, and would have actually completely taken me out if I'd still been sat there. So somebody somewhere liked me that day, and I don't know why. Sorry, Nigeria, but that's the thing I always remember about Nigeria was the fact that I happened to take a bathroom break at exactly the right time. So no bathroom breaks for me on this one. It's a recording anyway, so you wouldn't know if I did. But I'm going to talk about cash modeling here for the next few minutes. So look, I'm seen often as a kind of like a financial modeling guru these days, for want of a better phrase. I don't know. I just try and keep it as simple as possible. In uncertain times like we're living at the moment, it's as important as ever. And look, just so I'm not sexist, cash is still queen. It's most important. It's all very well trying to ramp up profitability and things like this, but if we don't have the cash to support it, we're going under. And people and businesses are struggling at the moment. I can't speak for Africa, but I know here just in Melbourne, Victoria, we've had nearly 250,000 cases of companies closing down. There's only 28 million people in the whole of Australia. This is an incredible number. So it's important to get your forecasting right, and it's important to get the cash modeling correct. And the trouble is, that's not how we model. And that's why I want to give you some cash modeling tips in this particular session, if I may. They may seem basic, but they might just give you some new ideas. That's what the whole point of this is. So I know not everyone here is going to be an accountant, and I know everyone's really looking forward to Death by PowerPoint, so I'll try and keep out of these slides as quickly as possible. But let me just go through the three the three primary financial statement types. We've got the income statement. That's the P&L to you and me. It's a summary of the revenues, the cost of goods sold, and expenses. It calculates net profit after tax for a period of time, so you can actually see your profitability. And this is how people think. More on that in a minute. We've then got the balance sheet. It used to be known as the net worth statement. It's what you're worth at a point in time. So not cumulative, but it's a snapshot. It shows the status of assets, liabilities, and equity at a point in time. Now, if you're thinking, look, stop talking accounting jargon at me. Assets are things that you're owning or have control over, should we say. So if you're buying an apartment or something like that, or a house or a car, then it may be you don't buy it outright, you take out a loan against it. So the asset, the car, the house, the apartment, whatever it is that you're taking out, that goes on your balance sheet as a positive. The amount you borrowed against it is the liability, and the difference between the two is the equity you have in it. So it's always got a balance. I mean, accountants dress these things up and make it sound like it's some sort of rocket science or some sort of mystique, but it isn't. And it's just a case of making sure that you've got a positive number for equity at any point in time, and the whole thing balances. And if you haven't, you've messed up your model. Now, those two were the primary financial statements, but then along came the cash flow statement, because cash was just an item on the balance sheet, but it's taken on a life of its own because it's just so important. And it shows how the changes in the income statement and balance sheet affect the items of cash in the bank. And we split it up into operating, investing and financing activities. But the point is, I want to talk about modeling cash because at this moment in time, with businesses struggling and we're not quite sure what's going on, as we think, well, we're into COVID year 2 now, what's happening. The point here is to try and make sure that our businesses survive. Now, I'm going to start with the income statement now, which might be surprising, but the reason I start with the income statement is very, very simple. If you ever ask anyone to build a financial model and you say, right, what are you going to build? They'll say, well, first of all, I need to work out my sales, and then I'll have to work out my costs and what my capital is I'm going to need to buy for it. And you realize what they're doing is, even if they're not an accountant, they're talking P&L. They're saying, right, I want my sales. And then I want to work out the costs that are going to be directly attributable to those sales, whether that's known as cost of goods sold. That's going to give me my gross profit. And then I've got other expenses, like it might be staff salaries for admin. I've got heating, lighting, electricity, all those sorts of things. So that's my operating expenditure. That gives me my earnings before interest, tax, depreciation and amortization, EBITDA. Then we have a proportion of the capital that we spent, so this is our depreciation, etc., etc., etc. Now, this is not an accounting 101 course, but I just want to explain that what it is when people build models, they always model it in P&L terms, because this is how we think. When you get your paycheck at the fortnight, the end of the month, whatever you're getting as your remuneration, you don't think, yay, party now. You're thinking, right, I've got to actually save some of this because I'm looking at going on a holiday or whatever in the year 2058. I'm also having to buy food, clothes, heating, lighting. I've got to pay my rent, my mortgage, whatever it is, etc., etc. You are accruing. You're not just thinking, let's just blitz it now. So we think like accountants. It's a bit of a scary thought, isn't it? And this is the whole point in here, that we model this way. So if we were going to model revenue, we work out, right, well, what's the unit price for whatever it is we're selling and how many are we going to sell? And that would work out our sales. That's what you treat as sales. But yeah, but when are you getting the cash? That's the key thing here. We tend to think in P&L terms. That's what I'm saying. We think on an accruals basis, and to quote Elvis Presley, don't be accrual. Be cash based, because it's most important currently. There are timing differences. Yes, you make a sale. The customer gets whatever it is you've sold to them, a product or service. You send out an invoice, and if you're lucky, 30 days later or so, you get the money back. And that's what we've got to do. We look at these timing differences and see when we're actually going to bring the cash in. The balance sheet just summarizes it, and I put it in for completeness. So you've got your assets, your liabilities, and your equity. I have no plans to go through this in big detail here, because this is really about converting P&L to cash flow and the fact that the balance sheet must still balance. Notice here, the cash is on line 2 in the current assets section here, and the net profit after tax from the P&L is on the third from last line, right at the bottom, just before the total equity total. Yes, too many totals in one sentence there. Net assets has to equal total equity. It must balance. If you've got your P&L, your cash flow, and your balance sheet all linked together, and they always balance when you change the assumptions, that's what we call three-way integrated. Sounds kinky, but it's just, in fact, financial accounting. This brings us on to the cash flow statement. So I said there are 3 elements to this: operating, investing, and financing. For the example I'm going to show in Excel in a minute, yes, I am going to Excel, don't worry. I'm going to have here my operating. It's going to be the revenues here. So I've got my cash receipts from my sales, my cash payments, any interest paid, which people find surprising that interest should be in here. And there are arguments, some people will put it in financing elsewhere. Don't want to get too embroiled, but I'm a bit of a traditionalist and put it in operating cash flows. And of course, the tax paid. Then you've got investing, which can be any interest received, dividends received, and capital expenditure. And then financing, the drawdowns and repayments of debt and equity and any dividends paid. That all added together gives you your net increase or decrease in cash held, and in uncertain times, you want that hopefully to be positive for any given period. That's the whole point. As we get into real areas of uncertainty, the cash flow statement goes from being a thing we think about every year to every quarter to every month to every week to almost every day if you're really struggling. So it's important we model it correctly. Notice how I've modeled the operating cash flow here. I've gone cash receipts, less cash payments, less interest paid, less tax paid. I could actually reconcile this directly to my bank account. And this is known as the direct presentation of cash flow, because that's the way we actually model, we can tick it off to actually go to our financial bank accounts and check the numbers off. Now, that's all well and good, but if you're a modeler, most people will do it a different way. They might use a method known as the indirect method. Now let me talk about direct versus indirect reporting, where I've got here quite a detailed little presentation. I've got at the top, I've broken down my cash flow from operating activities on a direct method basis. I've got my billings, I've got my cash receipts total, I've got my cash payments, interest paid and tax paid. It looks quite long, but essentially it's just 4 elements. The cash I've got in, the cash I've paid out, the interest that's been paid, and the tax can be reconciled directly to the bank account. This is the way I suggest you model. Newsflash, likely if you're modeling at the moment, that's not how you're doing it. Because we all think in P&L terms, we build a P&L. So we have a net profit after tax. So what we've got at the bottom here is we've got net profit after tax, and we realize that there are things in there that need to be added back and other things we should be changing off. It's as simple as this. If you can't quite read the slide here, I apologize, it's a bit tiny, and I normally have a whiteboard to help me, but just to go through quickly. With net profit after tax, you've got non-cash items. You've got interest expense, you've got tax expense, you've got depreciation. They're not cash items, so we add all those back. Then we put through our movements in our working capital. That is the amounts we've not yet paid for bills we owe on, and also the amounts we've not yet received for invoices we've sent out. Those movements each month have to be put through. And then instead of interest expense, we add that back and we put through instead interest paid. Instead of tax expense, which we add back, we put through tax paid. But for the actual the depreciation expense, we do add that back because it's a non-cash item, but we don't do anything else because the cash version of that is your capital expenditure, and that's in the investing section. So in fact, we've got to be careful. Sometimes people will double count in their cash flow statement, so just be careful how you're modeling this. Now, most modelers will want to do it the second way because they've got all these items already in the P&L. 2 reasons why I don't like this. First reason, if you do it this way, you've got no sense check of deriving the numbers in a different way and making sure you've not made a mistake. That's part 1. Part 2, it doesn't work for the foolproof method of making the balance sheet balance if you do it that way. And if the first argument doesn't sway you, hopefully the second argument will. Okay, let's carry on then. I want to talk about what I'm alluding to here. What's the approach for actually getting these 3-way integrated financial statements? I'm going to use something called a control account. That's what we're going to model up. That's what I'm going to show you here and show you some different ways of actually modeling it in Excel. It's a great method for non-accountants and simple Excel modeler alike. And by simple Excel modeler alike, I mean someone that just does it simply. I don't mean it's simple. I mean, I like Excel modelers that model simply. And to make 3-way integrated financial statement construction trivial. That's the whole idea. So a control account is just nothing more than a reconciliation of how a balance sheet varies from one period to the next. It's as simple as that. And the best way of explaining it is to show you one. So I'm going to do an Excel example in a moment, but just before I go through that, let me just explain the idea of a control account here. I'm going to work out what is my accounts receivable. That is the amount I'm owed from customers. So I've sent them an invoice. Some of them paid, some of them haven't, and I want to show the state of affairs. Now, to show what's still owing to me, that's known as the debtor balance, because customers that have not yet paid their bills are known as debtors. Or we can say it's also the accounts receivable, so the amount that's still owed to us. And then we put this BF and CF in front of it. It's not BS. Yeah, BS is balance sheet, of course, in case you were thinking anything else. BF means brought forward from the previous period, and CF just means carried forward into the next period. So it's just a way of showing that it's the before and after for this period of the balance sheet. So the top and bottom lines of a control account are always, always, always balance sheet items. So I'm saying at the beginning of the period, nobody owed me anything. I was completely caught up with any invoices, or I've just started out, something like that. Then I've got the sales I made for the period, $1,000, and the cash receipts are $753. And at the end, I've got $247 owing to me. Now, the top and the bottom are both balance sheet items. If I put those in the balance sheet, great. If I put sales as a P&L into the P&L as revenue, as a positive number, great. If I put my cash receipts into the cash statement as a positive number, positive, it's just deducted here to show what's owed, then you'll find if you put those numbers into a model, it's got to balance. Everything will work. Everything you build into financial statement outputs in an Excel model should link to a control account. And what you do is, it's a very simple rule. Top and bottom are always the balance sheet for previous period and current period. So ignore the top row because that's being modeled for the previous period. Then the key driver is always row 2. If there are no sales, there'll be no cash receipts. And if there are no sales and no cash receipts, nobody's going to owe us anything. So everything will be zero. So if you're going to do any sensitivity analysis, always do it on something that's associated with the line 2 item, which here would be sales. Once we've got those in here, the sales will go into the P&L, cash receipts into the cash flow statement, and the accounts receivable into the balance sheet. So the control account tells you the order to do it. Put sales into the income statement, cash receipts into the cash flow statement, and accounts receivable into the balance sheet. It has to balance. It shows you the key drivers as well, and it tells you you need 3 calculations to make it balance, always one less than the number of rows in the control account. And that goes against the whole concept of, you might have heard of, a double entry, where you think you do one thing, you do another, and everything balances. This is what confuses so many people and why they get into such a mess when they build financial models. No, simple algebra. Have you heard me talk about debits and credits? Yeah? Well, actually, I have in that last sentence, but you know what I mean. So let's go and take a simple example and show you how this works in practice. Okay, death by PowerPoint over. Let's move into Excel. And I'm going to start with a simple modeling example, which is going to use revenue and debtors to show how to model cash and balance the balance sheet. And this is where we're going to spend a bit of time now and talk through the ideas for kind of like a best practice approach using control accounts to make balance sheets balance. And most importantly, make sure you've got that cash under control and you understand it. That's the idea here. So this particular workbook is a kind of template that we use. It's got some product logo on it. I'm from some product, hence that's why it's got the logo. And yes, I know some product is an Excel function. That's why I called it that. Like Victor Kayam, I was so impressed with the function. That's why I actually named the company after it, or I bought the function or whatever. Anyway, I have a navigator page down here, which has got a way I can link between all the sheets if I want to and come back. I've got a style guide. So if you're wondering what all the pretty colors mean, you can follow that too. And I've got the model parameters. So if we have to put constants in our formulas, like perhaps quarters in year or number of days in a year or rounding accuracy, things like that, we've actually given these range names. So days in year, months in month, etc. I've got an assumption sheet, very, very simple here. I'm just going to be looking at sales. I've got some calculations, keeping it separate from the input page. And then I've got my outputs. I have an opening balance sheet, which must balance, and it's just blanked out. So this is either a startup company or it's just not had the data put in yet, but it balances. And you see if I put some numbers in here so that you'll see they'll just flow through because I put a subtotal in. I put a little balancing figure in retained profits, which is the only place I've actually put a balancing figure in because the opening balance sheet must balance. You can't do anything in modeling to make it balance. You just have to have it balanced. So that's my balancing fact there, just to show you that it's working through. And I've got error checks up here to say everything's working fine. Then I have my income statement here. Now I've put in some subtotals here, 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 and so on. So that if I put a number in here somewhere, it will flow through. And notice as it flows through, do you see that it triggers this little conditional formatting that says, we've got an issue. So if I click on this, it takes me back to my not control accounts, but my error checks as sponsored by Specsavers until I actually make it bigger. And you'll see it says the balance sheet is not balancing. And if I click on this to a hyperlink system, it's showing me that in these 3 periods, my net assets are 0, but I've got profits of 7 coming through, and I've got a problem. I can trace it back to this and think, yes, that's because I typed this stupid 7 in here, and then everything's fine again. So we have the balance sheet, which is obviously what we're trying to make it balance, and I put some checks in here that you can look at to your heart's content about prima facie error checks, not parcel force. This is error checks to see that if I put in here equals 4 divided by 0, for instance, that will trigger that. You've got an issue. If I have something that doesn't balance, so I put 14 in here, that's going to trigger the balance check. And if I make that 14 and I make this minus 14, for instance, so that it does balance, what happens in this particular case is I've got an insolvency. I've gone negative, and that's not good either. So you can have a look at this model to your heart's content as well. We'll make sure that Michael circulates this round, so feel free to have a look. Very, very simple. And then we have our cash flow statement at the end, also with the subtotals in, prepared on the direct basis. Now, if you want an indirect one, what you can do is you can put it down at the bottom and reconcile it afterwards. There's no harm in doing that, but I'm saying if you're going to use a control account method, you have to model on the direct basis to begin with. And it's good because it gives you an alternative approach to deriving the numbers, making sure they reconcile, and to actually safeguard you making some errors. So it's a good thing. Then there's other things like timing and error checks and things like that. But let's go back for now to the assumptions. And I'm going to actually calculate this. So this is all I need to work out my revenue. I've got my projected sales, and I've got my unit price, and I've got what the price is going to go up each year. It's going through like this. So I've also got my days receivable of how long it takes to get the money in. So let's go and model this. So I'm going to do this on the calculation sheet. And you may have noticed straight away that it's almost a mirror of the assumption sheet. Now, best practice tip number 1, how often have you got a model where it says equals sheet 5 D57 times sheet 17 C16 plus sheet 38 D53 divided by the sum of sheet 7G5 plus sheet 9G22, and you think, oh my God, I can't find anything. Isn't it better if you bring in all the things you need and just link them in, just simply? The only thing I will do is perhaps make a negative number positive. That's the only change I will do. And then you've just got all the actual numbers above you, so it's easy to follow. Now, in this simple, trivial example, there's not much value to be had because it's just putting it through. But it's a good thing to get into because sometimes you might hand these assumptions out to users to actually say, I need you to fill this in for the model, but you don't want them to have the whole model. And you want your calculations separate because either there's intellectual property involved, there's confidential data, you just don't want them to stuff it up. All these reasons. So again, it's simple. But for the decision makers who need to see how it's calculated, they can see this on a piece of paper and follow it. And that's the whole idea. So let me see if we can go through this. So my price per unit is going to be my unit price in the first period, then grown by the percentages thereafter. We want one formula we can copy across. You don't want to do this. You don't want to go equals this in the first period and then take equals that and multiply by 1 plus this percentage here in subsequent periods. That will work. That will work. I can't argue that. But, oh my goodness, it's dangerous because if you want more periods, somebody might decide, right, I'm going to drag this across, and suddenly, oh, it hasn't worked. You need one constant formula going across, and so we need to use an if statement. So I'm going to put in equals if. Right, if the counter, if this first period, so let's go over here, this first period, I can't do it on the date because the dates may change. So I'm going to anchor it. So $9 to anchor the row equals 1. In other words, if it's the first period, I want you to take that unit price, which I'm going to anchor. I just hit the F4 function key very hard. I hate it. $J$18. It's saying I want to stick in this particular cell no matter what happens. So if there is a delay and we start period 1 here, it will still work. Otherwise, I want you to take the previous period and grow it by 1 plus the percentage. Now, be careful here. This is a mistake a lot of people make. A lot of people will do this. They'll go and click on this percentage because it's the first time they see a percentage. There isn't one here. Now, first of all, I should anchor it so it's $19 and then close to brackets to get it to work. Now, you may not notice this. And here's another modeling tip for you. When you model, people always know the first few periods brilliantly, because then they it goes off sheet, and if they use something like Control Shift right arrow to copy across, they'll never see those numbers again. You should always look at the numbers at the end, because sometimes they go completely massive when they shouldn't. Sometimes they have errors in them. Sometimes they go big and negative. And sometimes, like here, these last two equal each other. Well, they would do if I actually put in here home and change it from custom to general, so you can see it, it's not hidden. These two equal each other. Why do they equal each other? Because what it's doing is this number here is taking this number and multiplying it by 1 plus the percentage, which is, if I press the F2 function key, a blank cell, because I've misreferenced the percentages because I was looking for a percentage in the first particular period. So that's not right. What I should have done here is taken this and not made it K19. I should have made it J19. It won't pick up this blank cell because in the first period it's a 1 and therefore it's going to pick up the 15. But if I copy that across now, you will see clearly these are different to these two periods. So watch out for that. That's a classic gotcha in financial modeling with this method of forecasting known as an amount and growth rates basis. Now the revenue is simply going to equal the projected sales multiplied by the price per unit. And away we go. And I've got my sales. And, you know, if you're building a more complicated model, you say, oh, it's not as simple as that. Yes, it is. You might have 26,000 product lines. You might have 38 different prices, and there may be different pricing points and customers, but you can just step it all out and keep it as simple. Most of my formulas follow something called the rule of thumb, which means every formula in the formula bar is no longer than my thumb. Keep it simple, stupid. Right, so that gets me the revenue part. Remember, so my control account, I have the revenue calculated, but there's more to my control account than that. So sorry, it's time to go back to the slides for a second. Let's return to the control account. You see what we've just modeled is our sales in line 2 of the control account, the $1,000. But we need the other line items. Remember, the accounts receivable brought forward is just the previous period's closing balance, so we just disregard that. But I need to calculate the cash receipts and therefore get the sum of the above, the accounts receivable or the debtors, the amount still owed to us, in order to get the rest of this control account nailed down. Now, in order to do that, I just want to go through a little bit of theory for a second, if I may. Sorry to bore you. I promise most of it's Excel now, but there is still a little bit of death by PowerPoint to come. For those that aren't quite clear what working capital and all these things are, basically, when you're going through, I mean, you have, you raise a purchase order, somebody comes in and gets it through, you have your raw materials inventory, you bring in your raw materials if you're making a product, you convert it efficiently to work in progress so that eventually you have it in other productions, you have your finished goods that you can then sell, you might have to distribute it, you make a sale, then the money is then owing to you from the customer, they're the debtors or the receivable, and eventually you get the cash and you can invest again, and it's just a cycle that goes on and on and on. And trust me, you have no idea how long it took me to get that circle to look like a circle. Anyway, stop whinging, Liam. If I'm going to calculate this, the standard way of doing this is as follows. So I've put up in the top right hand corner the control account again, the accounts receivable brought forward, sales, cash receipts, and accounts receivable carried forward. And what I've modeled is the income statement number, the $1,000. And I've said in this particular case, it's over 365 days. So I'm going to assume it accrues evenly over time, about $3 a day. That's as much as I make at the moment. Let's make a duplicate. There you go. But I don't want it to be a duplicate. I actually want it to be a reflection of the cash flow statement. So what happens is I turn to the cash flow statement and I move it. So that what happens is the sales I make at the very beginning of the period are coming at the beginning of the cash flow period after this credit period part. So you see that first arrow that goes from the what would it be, the northwest corner to the southeast one there. It's just showing how there's a displacement in the cash flow statement, and some of the sales are still owing after the 365-day cutoff. So initially I made $1,000 of sales. What's happened in the period, $753 has come in. That means I'm still owed $247, which you can see visually is the numerical value attributed to the credit period. So I can actually work out what my credit period is. It's simply 247 thousandths of 365 days. If all you heard was blah, 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 well, welcome to my world. Essentially what I've done is derive this formula where my days receivable is actually my accounts receivable, so the amount owed, multiplied by the days in period, divided by the sales in the period. I've worked it out. And if you're still not following this, don't worry, let's put it into numbers. My days receivable is 247 thousandths of 365, which is 90 days. It's as simple as that. And so I can work out what my accounts receivables are by saying, well, if I know what my days receivable are, it's going to be my sales in the period multiplied by the days receivable divided by the number of days in the period. Now be careful. Common mistake number 375 here is that people always put for days in period 365. Not true. It's whatever periodicity you're modeling to. So if you're modeling to a month, it's going to be 30 days or so. If you're modeling to a quarter, it's going to be between 90 and 92, etc., etc., etc. Be careful. Common mistake. And the other error, only put your sales in that are credit sales. If you're getting some that are cash sales, disregard it. That's one of the big mistakes that people make. Just be aware of this. Okay, get off my soapbox now. Let's return to the Excel example. So now I return to my Excel example. I'm back where I was before. I've still got my revenue calculated here in row 23, and I need to work out my working capital adjustment. So I brought in my days receivable, which now seems to make sense. It's 60, which is going back to my assumption sheet, the 60 here. So it's effectively what I'm saying is it's taking 2 months between making the sale and collecting the actual cash in. That's the thing. We model using our sales because this is how we all think. We think in P&L terms. That makes sense. But to derive the cash flow, I need this calculation. Now I need the days in period because of the reasons I've just explained. So I've got that, I've got my date, I've got my start date and end date here. So common mistake people make is they go equals end date. So that's row 7 here, minus the start date. There you go, 365 days, except it's wrong. You may have noticed I've used the year ending June 2020. And you think, Liam, it's currently going to be, well, I've recorded this in March 2021. You're going to see this in April 2021. Couldn't you have at least made it up to date? No, I wanted to use 2020 because A, it meant I didn't have to change anything from my previous example. That wasn't the main reason. 2, it's a leap year. How many days are there in a leap year? 366. And this is a common error you see. I think because I see 365, it's right. But if I take the 30th of June 2020 and subtract off the 1st of July 2019, that means my year is going from the 2nd of July. I've missed off one, so I would actually have to go through here and add 1. So just be careful if you ever do that with dates, yeah, and then it will work. Now, I'm not going to do that anyway because I've actually calculated the number of days in period in row 8. So I'm just going to use that and make it anchored. So if I copy it somewhere else, it will work. So my closing receivables then, the formula is quite simply the revenue multiplied by the days receivable divided by the number of days in period, assuming these are all credit sales, which we're going to. So it's a very, very complex calculation. That multiplied by that divided by that. Not the end of the world. And there I've got my closing receivables. Excellent. Let's scroll down a bit and we can see down at the bottom here, I've got my control account. Now, notice this little grey box here means this is going to be an off-sheet reference. That's what these grey cells mean, that it's referring to something on another sheet, so it's not a calculation that's been done here. And this has got to link back to my receivables on my opening balance sheet. So I'll go to my opening balance sheet, and my accounts receivable is here in row 15. Click on that cell, and it's best to anchor it. So I'm pressing the F4 function key, $I, $15. So I've got that in here. Now, my opening receivables are simply going to be the previous period's closing. So that's easy. Copy it across. My sales I've got in row 23. So I put this in and click on there, copy it across. My closing receivables, not the cash receipts, but my closing receivables are what I've calculated. So that's going to equal this number here. And if I copy that across, I've got my closing receivables, and I get this stupid line coming, which drives me mad. So little tip for you if you have that. Right, don't copy it across that way. You go copy, so Control C or right click and copy. So I'll go Control C to copy. And then I'm just going to highlight these cells and paste special, Alt ES gives you edit paste special. And then I can go in here and there is all except borders here, if you see, Alt ESX. I always remember that keyboard shortcut, but that's because I'm dyslexic. I have ESX on my mind the whole time. Actually, I shouldn't make fun of dyslexics. I belong to, well, I'm a big fan of DNA, the National Association of Dyslexics. And I've got a friend of mine who he's a bit of an atheist. He doesn't believe in dogs. And he tells them that when it's Christmas, it's Satan that provides the actual presents. Anyway, okay, politically incorrect jokes over. Let's just click OK at this point. Notice now, no border, I've got these numbers in. So to actually calculate the cash receipts, it's simply going to equal the closing receivables minus the sum of these two numbers above. Now, yes, it's a balancing thing, but the fact is it's easier to derive this number and then work out this one than the other way around. So that's why I do it that way. And then we have our control account. So if I make this bigger, let's just just make this a little bigger here. This line and this line, you can see, are BS. Well, they may well be. That depends on the assumptions. But they're balance sheet items. So this is for the previous period. This is the current period. This is the driver, the revenue we calculated earlier. And this is a positive number will go in as cash receipts. So remember, it shows there's 4 lines in the control account. You always subtract 1 because the opening receivables is just the previous period's closing receivables. So we've got 3 calculations to put into the financial statements, and then it will balance. That's what we do. The driver is row 2, the revenue, which goes into the income statement. You can see here. The cash receipts as a positive number, don't leave your brain completely at the door, go into the cash flow statement. And if we put the closing receivables numbers of these in, we won't need to do any of these equals minus open brackets, previous period minus current period, close brackets, minus open brackets, previous period minus closing periods, close brackets, multiplied by -1 times -1 times -1, or horrible calculations you've done that in the past to calculate the balance sheet. It's simple. Let me show you. So we've got 3 line items. Let's put them in. Go to the income statement first of all and put revenue in. So go into the income statement. Here's revenue in this line. Go equals, only linked to control accounts. So go back to the calculation sheet, click on this and copy it across. And as soon as I do that, notice this triggers. Click on this. Doesn't balance. Go in here. I've got numbers coming through here, but my balance sheet is not balancing. That's okay. I've only put 1 of the 3 calculations in. If it did still balance at this point, I'd know there's something wrong with my model. So here we're using an error check in reverse, in effect. We want it to trigger. Otherwise, we've got a problem. This is why you build error checks at the beginning, not at the end of a model. Yeah. Okay, simple if you know how. That's what I keep telling people as I try to pretend to do brain surgery with a spoon, but I can't get any volunteers to help me. Next up, the cash receipts go in as a negative number into the cash flow statement. So we'll go to the cash flow statement, and where it's cash receipts here in line 16 equals minus, and I'll just go back to my calculations here, click on this number, and copy it across. That flows through. You see it flows through here. It's not flowed through here because I haven't bothered linking it in there. That's something you can do for homework should you wish. We've got these numbers in here, and if we go to the balance sheet at the top, they flowed through because it's linked in here as well. But it doesn't balance, and it shouldn't, because I've said if I go to the calculator, I need 3 things to get it to balance, and I haven't put the closing receivables in. So let's do that now. So go to the balance sheet, go up to the top where it's accounts receivable, equals, and this is it. It's just simplicity if you've got the control account. Go to the calculation sheet, click on this cell here, press enter, copy it across. It balances! Yay! Run round room naked, cheering, then go to padded cell, get arrested, whatever. But the fact is, you've actually got a balance sheet balancing. If you've ever worked with financial statements and modeling, and every time you have actually got a balance sheet to balance first time perfectly and no problems, you are a pathological liar. The number of sleepless nights I've seen people have trying to get things to work and can't get it to balance and struggling to the wee hours. If you use a control account, it's going to make it easier. And we've got to work this out now because we've got the cash now. It's the cash that's important to see if we've got problems or not in a current and uncertain environment. That's why I'm emphasizing this. So I could just stop there now, because that's it. That's it. You do the same thing with cost of goods sold, operating expenditure. You do the same sorts of calculations. It's all very, very simple. Very simple, very similar. Now, I want to revisit this and just say, this is all well and good, but we have a problem. This is all fine in this situation, and I can just draw a line under this and say, yep, tick, that's how you do it. And perhaps you can see now why you need the direct cash flow statement method, because we needed to have cash receipts in here. That's why we needed to do it. We didn't. Where would we have put the cash receipts if we'd done the indirect method? Because we'd have just had net profit after tax. How would we have done it? It would have been more of a mess. This is why we do it this way. Hopefully that makes sense. But what's the problem? I have another file here. This is the working capital adjustments file, and I can demonstrate what the problem is in here, and I can illustrate what's going on. Show you a nice pretty chart at the same time. So this works equally well for debtors and creditors. So I can change from here, debtor to creditor, and makes no difference. It just changes the label, so it's not the end of the world. And I've got my days receivable currently set at 90, which is the example 1,753 and 247. So you can see it's going through sales in period, and I'm going to go for days in year 365, and it shows that. And if I change this to 60, you can see how it flows through. If I change it to 180, you can see how it goes through, and I can use this little slider as well should I wish. This clever little chart. Let's put this back to 90. So it's working fine. I've got to keep my cash under control. I've got enough to pay my amounts I owe, like payroll and tax and all the other suppliers, everything I've got to sort out. Have I got enough? So days in month, let's assume it's just 30 in each month. Ooh, what's happened now? Well, my chart's got completely and utterly stuffed. But down here, my sales in period are still 1,000. Let's look at the closing debtors though. Closing debtors says that it's going to equal the sales in the period 1,000 multiplied by the days receivable, which is 90, divided by the days in the period, which is 30. Well, 90 over 30 is 3. So the amount owing to me is 3 times what I've invoiced. I've become a loan shark. Well, it'd be great if you can get away with it, but it does tend to be amoral, illegal, whatever. The point here is this is not good. And of course, cash receipts now have become a ridiculous number. They've gone positive when they should be negative. This makes no sense. You can't do this. You cannot use this method of construction of calculating your cash if the number of days receivable or payable exceeds the number of days in the modeling period. And as cash gets tight, we tend to model with more regularity, like weekly, daily, fortnightly, whatever. We cannot use this method. Now, this is the simplest method. So if you can use it, use it. But just be aware that in these times, this may not be the appropriate way. So we're going to have to come up with another way to get that control account populated. And I'm going to show you 2 other approaches. So the first one is probably the more common, is the monthly Calcs way. And the way you do this is you simplify it. You say, right, I'm going to have an average number of days in my month, and I'm going to assume in my case it's 30. You can do it trading days, you can do whatever you like. I'm going 30. And I'm going to go for days receivable of 75. So first of all, I need to know how many complete months it will be before I get anything. So if you think about it, if there's 30 days in a period, then it's going to be the 75th day is going to occur in the 3rd period, because the first period will have the first 30, the second will have the next 30, which is 60 in total, and then the third one will have 90, and 75 occurs between 61 and 90, so it's in period 3. So the number of complete months will be 2. And we can use a good old Yorkshire function here to calculate this, the int function, int, which calculates the integer part. And I'm just going to go here, equals, well, I'm going to go int, open brackets, this number here, the 75, make that absolute, so it's not going anywhere, divided by the number of days, average days in month. And that will give me 2. Now, that's all well and good, but just one thing to watch out here is that if this is blank or something, if I accidentally delete this, I get a hash div 0. So it's best to actually put in here a little check. Whenever you've got a division, it's always a good idea to do this. I'm going to type in if, and not if error. Don't use that because that encapsulates too many other things where you could have stuffed something up. Average days in month is not equal to 0. Then calculate this, otherwise nothing. That will work. Now, if this is 0, it just goes dash. That's fine. Makes it more professional. But you don't need this. It's not equal to 0. Every number in Excel is valid as true other than 0, so I can get rid of that and just have that. See? It does the same thing. And I make this 0. It's all good. So that gives us the number of completed months. Now I need to work out the proportion in the final month. So if I've got 2 complete months and then it's a case of it's coming in the 3rd month, well, how much into that 3rd month is it? So I need to work it out. So it's going to be, well, let's take off the multiple number of days. So it's going to equal, open brackets in a minute, calculate it through, this number here, minus, and we'll do this in brackets so that we can have no issue with it, J18, 2 times the number of days, close brackets, close brackets. So that will give me 15 days because it's going to be 75 minus 2 times 30 is 60, 75 minus 60 is 15. And it says 1500% because I've put this in percentage format for reasons that will become clear in a second. I now need to divide that by the number of days in a month, which is that, press enter, and it's 50%. And now what I need to do is wrap all of that in an if statement. So if, open brackets, average days in month, comma, do this calculation, otherwise, comma, close brackets. That's going to put it still to 50%. And now I have got the number of complete months, and then I'm going to say, well, there's a proportion, 50% going through in this 3rd period. And that's what I'm going to use in order to displace what's going on. Now, I'm going to derive the calculation first and explain all this, and then I'll show it you working afterwards, and so that you will follow it a bit more clearly. But to do that, I need to look at a function called offset. So let's do a crash course, if you don't know it already, in the offset function. Time to introduce you to a new function, if you don't know it already, offset. Now, offset is all about disposition, not that position, but disposition. It's about displacing, moving somewhere else. You start in one place and you tell Excel to go somewhere else. So if I have a grid here of the numbers 1 to 36, it's not about selecting the whole grid, it's about selecting somewhere in this grid. And the easiest way to explain it is to show you with an example. So I'm going to go here and I'm going to type in equals offset. And you can see here it says it wants a reference, then the number of rows, and then the number of columns, and it's got optional arguments for height and width. And the height one I'm calling depth for reasons that you'll see in a moment. So let's start off in this cell in the top left hand corner, cell B2. And I'm going to actually say, I'm going to click on this, the number of rows, and this, the number of columns. And then close brackets and press enter. And it gives me the value 1, which is where I was, which is, that's really useful here. But if I type the number 2 in here and the number 3 in here, look what happens. It's saying, start in this cell B2 and move 2 rows down, 1, 2 to the number 13, and then across 3 columns to the right, 14, 15, 16. And that's how the value 16 came about. See how it is? It's about displacement. Start in cell B2, end up in cell E4. This is a great way of creating scenario tables, sensitivity tables, and so on. You can move things around and makes things more dynamic. It's a dynamic range reference. Now, if I change this instead from B2 to cell D4, the value 15, it goes to 30, because again, it moves down 2 to 27 and across 3, 1, 2, 3 to the number 30. That's how it works. But now more in the middle, let's play with the sign. Let's make this -2. Now it's number 6. Do you see why? Because now the number of rows is going up 2, 1, 2, and then across 3, 1, 2, 3. And if I make this -2, well, I start in 15, I go up 2, and I go to the left 2, and I'm back to the starting point of 1. So you see that the positive and negative signs are important because it specifies a direction. And positive numbers are just like reading a book in English. You go left to right and down the page. So negative means go right to left or up the page. That's how this works. So I've got this little thing here. Now let's put in the fourth and fifth arguments, the height and the width, except I call it depth for reasons that will become clear in a second. I'll put in 2 and 2. And then in here, I'm going to add those fourth and fifth arguments. So I'm going to put the depth and the width in and press enter. Now I have got Office 365. When I do this, this will spill is what we call it. And it gets it, it's not formatted because spilling doesn't. So I'm just going to center it. There you go. Center it, I should say. So I've got these in here. It's spilled it into this range. What's going on? Well, it started off with the value of 15. And as I explained before, it goes up 2 rows and it goes across 2 columns to the left back to the value of number 1. But then it's got a depth of 2, and this is how much you're taking the range. So it's going to be, with it a 2, it's going down the page. So it's this row and the row beneath it. So it's the 1 and the 7. And it's a width of 2. So it's this column and the column to the right. See how that works? So it's the 1, 2, 7, and 8, which is what it's come out with here. That's it. So if I'd actually started off instead and I changed this to number of rows is going to be 1, I did this, I get 19, 20, 25, 26, because I'd be starting in the 15, I'd be going down 1, and then across to the left 2, and then it's going to be these 2, and those 2 gives me those values. And if I make this 1, 1, I go from here to picking up those values. And if I make this -2, what happens now? I go here, I go down 1 row, across 1, that's my starting cell, but then my depth is -2, so it's this row and the row above it, so it's the 22 and the 16, and then across 2. See how it works? 16, 17, it's as simple as that. If you're thinking, Liam, this is great, what the heck has this got to do with cash and working capital? Let me show you. Let me return to the monthly calculations example I'd started previously. Remember, I've got my complete number of months that I've got to include and also the partial amount of a month to include. And there's 2 parts to it. And so I'm going to be using 2 offset functions to help me work this out. Now, to create my cash receipts and my closing debtors, I'm going to need a control account again. And lo and behold, I've got that in rows 25 to 28 down here. Now, row 26 has got my sales in period, which I've just got as input numbers here, but they could be calculations like in the earlier example. And my opening debtors is nice and simple. I just said, look, if the counter here, row 23 equals 1, then it's just going to be 0. There's going to be no opening balance. Otherwise, it's going to be the previous period's closing balance. So we've got it going like that. For the cash receipts, just the same as before, it's going to be based on the closing debtors minus the sum of the 2 rows above it, just as we did before. It's all to do in this particular instance with calculating the closing debtors, and there's 2 parts to it. The first part I've got to do is calculate the complete number of period sales that need to be included in the closing debtors. So here it's going to be this up to 2 months, but in the first period there's only 1 month of sales. In the second period there'll be 2 months I can include. In the third month there'll be 3 months. No, I've only got 2. So it's going to be the minimum of the counter and this complete number of periods. So in the first one, I'm only going to be looking at this sales, just 1 lot of sales. In this one, it'll be 2. But after that, it's just going to be 2, 2, 2, 2. That's what I need to calculate. So first of all, it only happens if this number is greater than 0. So I'm going to put in here, okay, equals if. Well, if this is a number here, I'll make it absolute, is greater than 0. Now, because this number can't be negative, I can just put if $J $18. Remember, any value other than 0 is true. Then I'm going to go, right, I want to sum it. But sum what? I'm going to use an offset function. And I'm going to base it on my sales, J26. Now, I don't want to look at any displacement. So number of rows, 0. Number of columns are moving, 0. The height, it's not 0. The default value is 1, but just make it clear, it's going to be a height or a depth of 1. And the width is going to be up to 2 complete months. But in the first period, it's restricted to a 1. So I've got to use a minus a min function. and it's going to be this value here, $J $18, and the counter, which is J $23, so that it can actually move. Close brackets, and then I'm going to close brackets 2 more times to finish this off. And then, of course, if J18 is 0, I don't want it to calculate anything, so I can put that in. But because I'm lazy, I'm going to get rid of the 0 here and press enter. And you can see if I copy this across to here, in this particular period, it's taking the 100, which is this. In this one, it's taking the 300, which is these two. In this one, it's taking the 500, which is these two, and so on. It's not quite right because there's a partial proportion as well, which is why I need a second function. So to add to this, I need to count about the actual the proportion that's left over. So it's going to be plus if, open brackets. Now I'm going to go back in here to my counter, J $23, minus my complete number of months, J18. Well, if that number is less than or equal to 0, then we don't want to calculate anything. So it's 0, like that. But I'm going to just put comma, comma, because I'm a Culture Club fan. And then otherwise, it's just going to be, there's no need for a sum. It's just going to be an offset this time. I'm going to go back to our sales, J26. And this time, I don't want to go any rows down, but I do want to go so many columns to the left. So it's minus. And the number of periods we're going to go back is how many periods where we need to go after the complete number of months. So we've included in the complete months, if it's 2, it'll be this month and the previous month. So the actual month we need to consider is the month before that. So we need to go 2 months back. So it's actually going to be this number here, minus $J18, close brackets, and then we just multiply that by the proportion. Okay, $18, and we go close brackets. Put that in. Let's copy that across. Now, at this point in time, if I just put formula text in so you see this horrible formula in all its glory here, it looks pretty yuck. But if you're not quite following it, well, there's plenty of time to digest. You've got the example. Let me put the days receivable to 0 and see if it's doing what it should be doing. If the days receivable is 0, i.e. everything's getting paid as it is invoiced, well then the sales in the period equals the cash receipts, and that's definitely happening. Now, given every period is 30 days, if I put 30 days in, I'd expect everything to move 1 period to the right. It does. If I go 60, it goes 2 periods to the right. Just look at the cash receipts in row 27, it's just displaced 2 periods to the right. Now, if I change this to 15, I would expect half this number to still be outstanding at the end of each period. So half of 100 is 50, half of 200 is 100, half of 300 is 150, and so on. Now, if I add 30 to that and change the 15 to 45, I would expect the cash receipts would all go 1 period to the right. So instead of being 50, 150, 250 coming in here, it would be displaced 1 period to the right. Let's try that. So put 45 in. Indeed, that happens. And so if I put 75 in, it puts it in a second period and so forth. And the same if I put 10 in. With 10, I would expect that you've got 10 out of 30 means that days receivable, 2/3 will get paid in the period and 1/3 will go to the next period. Let's see if that happens. Indeed, it does. 2/3 comes in, 1/3 goes forward to the next period, then 2/3 of this one gets paid. To 2/3 of 200 is 133, plus 33 means 167 paid, and 67 gets carried forward, and so on. If I add 30 to this, I just expect those cash receipts profiles to move 1 period to the right. And lo and behold, it does. So whether or not you understand this formula, it's working. And this gets around the problem of what happens when the days receivable or days payable exceeds the number of days in the period, because you can't use that simple calculation. Right, that's the second of my 3 approaches. Let's move on to my third. Here's my final approach that does get used from time to time. What I've done so far is I've assumed that for a particular invoice, it's getting paid at a point in time. Things accrue evenly in the first one, and the second one I'm saying, right, it's proportion, etc., etc. Well, there's another one where I'm saying it comes in sort of like dribs and drabs. So I get 40% in the first period, 25% in the second period, 15% in the third, and so on, which is my cash receipt profile in this illustration here. Now notice this does not add up to 100%, it only adds up to 95%. So I've got a bad debt. So what I'm going to do here is calculate this in this cell as equal to 1 minus the sum of all the payments coming in. So I've got 5% bad debt, and I've already got a little drop down box saying what period is that coming in. So what month am I going to write it off? So I'm going to write it off in month 6. So that means that 5% of 100 will get written off in month 6 here. 5% of 200 will get written off in month 7, and so on. So I need to write a formula, and again it's a displacement calculation, so again it's another offset function. And remember, the bigger but the columns I'm going to go to the left, and it's going to be not 6 columns left, but 6 minus 1. So it would be not add up to 100%. It only adds up to 95%. So I've got a bad debt. So what I'm going to do here is calculate this in this cell as equal to 1 minus the sum of all the payments coming in. So I've got 5% bad debt, and I've already got a little drop down box saying what period is that coming in. So what month am I going to write it off? So I'm going to write it off in month 6. So that means that 5% of 100 will get written off in month 6 here. 5% of 200 will get written off in month 7, and so on. So I need to write a formula, and again it's a displacement calculation, so again it's another offset function. And remember, it's only going to happen when actually the counter, which in this time is in row 11, is going to be sufficiently big enough. So it's got to be at least period 6 before I will even calculate it. So it's going to have to start with an if statement again. So let's go to my counter, $11, so that we anchor it, minus my month written off, which is G18 made absolute. Well, if that's less than 0, then there's nothing to do. So comma, comma. Okay, I'm not going to put that in. Otherwise, it's going to be offset the actual sales, which is going to be cell J13, and I'll just anchor that on row 13. Now I'm not going to move any rows down, but the columns I'm going to go to the left, and it's going to be not 6 columns left, but 6 minus 1. So it would be minus 6 minus 1. Well, I can write it like this. I can go minus this number here. Oh, I press the F4 function key there wonderfully before I click the cell. Always good. Minus G18. And it's going to be then plus the 1 to add 1 back. Well, rather than put plus 1 at the end, why not just put the 1 here instead? So I'll put it there. So it's 1 minus G18, and then it's going to be closed brackets for the offset, and it's going to be closed brackets for the if statement. And then we're going to multiply this by the bad debt proportion, which is the 5% in G17 made absolute. And we'll just copy that across. And you should see if I've got this right. I've got my sums calculated. 5% of 100 is 5 in period 6, 5% of 200 is 10 in period 7, and so on. So that's my bad debt. That will go into my control account. But there's more to do than that. I also need to have calculations for my forecast sales revenue. And this works a bit like a depreciation calculation. So down here, I've got, if I try and get this all on here, I've got my sales period 1, sales period 2, period 3, period 4. But little trick here. This is actually the end function. So the end function is just saying if it's a text, treat it as 0, otherwise take the value. Well, F28 is just this cell here, which is nothing. So this is just adding ones. This is just the numbers 1, 2, 3, 4, 5. And what I've actually done is if I go to Format Cells, Control 1 or Alt-O-E or goodness knows how else, you'll see what I've actually done is I've put this little thing in here. If I copy this out, let me just show you what I've put in. This is the actual syntax, sales, period, and then 0 is a number formatting. So I'm making it look like it's text. So for sales for period 1, period 2, when in fact it's just a number. Little trick for you. So this is using a number, and I'm going to be using that number to help me actually get my calculation sorted out. The first thing I need to do is here in column G, I want to bring in my 100, my 200, my 300. Now I can use the transpose function in Excel. I can also use dynamic ranges, but a simple one with offset is just to do the following: equals offset, open brackets. I'm going to stick on this cell here, which is I13, which I'm going to anchor. And then I'm not going to move any rows down, but I am going to go columns across based on this number here, which is going to be $F29. And so for every row down I go, it's going to go one column across. So it goes 100. If I copy this down, it's a nice, neat little trick I use all the time in modeling. It's giving me the values going down. So no need to copy paste special transpose or anything like this. If I change any of these numbers, 33, or like that, it will become 3333. See, nice simple trick. Now I need to put a formula in here which is a little bit involved. I need to make sure it's only going to calculate when the sales actually happen. So it's got to be, so the sales for period 2 only start in period 2. So I've got to be careful here, you know, that I'm not actually trying to calculate things sooner. So let's do it again. I'm going to take OK equals if, so another if statement in here. I'm going to go to my count. This time I'll use this one just to be clear. If $27, so if the count of the period number minus the actual period 1 when the sales occur, if that is greater than or equal to 0, then we can calculate it because it means it's starting. And then it's going to be another offset function, yet again, wonderful function. This a bit volatile, it's got some problems, but I quite like it. Then I'm going to go back up to take my percentage, and I'll start with, in this one, $15. I don't want to move any rows or any columns, but the actual, what I'm going to do, so any rows I should say, for the but for the columns, I'm going to go so many columns to the left, and the number of columns I'm going to go to the left is going to be based on this period number, and it's going to be one less than whatever this number is. So again, it's going to be minus F29 plus 1, which in other words is 1 minus, I love it when I press F1, 1 minus this number here, F29, which I anchor, and then I will go close brackets. And if J27 minus F29 is less than 0, then we don't want to calculate it at all. So it could be comma 0. I can just go in here, close brackets, and we're going to multiply that by this particular value of the sales, which I've just worked out, which is going to be anchored to the column G29. And if we put this across, you will see that if I copy this here, it's 40% of 100 is 40, 25% of 100 is 25, 15, 10, 5. But if I copy it down to the next one, you'll see it moves it across one. So 40% of 200 is 80, 25% of 200 is 50, and so on. It's moving it across. Just a neat little trick to get these in, and I can just copy that down, and I've put a little row total in here. So this is giving me my cash receipts. Now, for those of you that build financial models on a regular basis, you look at this and say, hey, this looks just like a depreciation grid. And you'd be right, because working capital adjustments are like the other side of the coin to depreciation. You see, in depreciation, what we do is we actually pay the cash all out in one go, and then we take the costs and we amortize them over a number of periods. In this one, we've actually got the expense or the revenue all accrued, and we're waiting to see the cash coming in amortized in its own way. Bankers call these payments and receipts amortization of cash as well. So it's the same thing. And this is quite a mind-blowing concept to start off with, because people don't realize that working capital and depreciation are so highly correlated. Now, the problem with this particular calculation is if I've got I had one model I was building where it was a 20-year monthly model. That would mean I'd have 240 columns going across, and that would mean I'd have 240 rows going down. That would mean 57,600 calculations, which is massive. If you've got lots of different sales product lines, that's going to be quite yuck. So there's another approach you can use in this particular method, which will do the same thing, and it's known colloquially as the reverse ticker method. Now, to explain this, I need to actually finish off with a function that our company knows very well. Our company is called SumProduct, and the function I'm going to finish with is SumProduct. Actually, I'm sort of lying. I need to explain two functions, not one, and I'll come to that in a second. The first one, I guess I say, is SumProduct, and the easiest way to explain this is by looking at this, where I've got two columns of data, quantity and price, and I want to work out what the total sales are. Well, I can just multiply this out and go 17 times 1, so I can just go in here and go, okay, equals that multiplied by that gives me 17. Copy that down, that gives me all my data, and if I sum it up here, Alt equals keyboard shortcut, it gives me 2,580. Or I can use the SumProduct function, which does the same thing. I go in here, I go this column, comma this column, and if I put that through like that, I will get in here, bang, 2,580 as well, same thing. Now the beauty of SumProduct is if I actually don't put a comma here but put times, it does exactly the same thing, but it allows me to do sort of calculations inside the cells. And if you're thinking, I don't understand, well, imagine instead I decided I wanted to divide quantity by price. I don't know why I'd want to do this, but let's just pretend I did. If I did that instead and put that down, it would be 27.48. But if I put it in here, it would also be 27.48. So that's quite a neat little trick. So it's a good habit sometimes to not put commas in, but to use the times as well, just as so you've got these other features available to you. But this is what I want to use SumProduct for a kind of like multiplying one row or one column by another row or column of the same dimensions here. That's not strictly true. There are other ways of doing SumProduct, but I don't want to get waylaid on that now. I did say there was a second function actually, and the second function I'm going to need as well is index. And so if offset is about disposition, then index is about position. And so I've got the positions 1 to 8 for my quantity, and I just want to say, right, what's in position 1, what's in position 2. So if I put in here equals index, and I highlight this whole column, just like that, and then say, right, position 1. This seems like a very convoluted way of getting that first cell. But it's useful because what I can do is if the maximum of this is 8, what I could do here is instead of saying, right, let me just go through, instead of B3, why don't I take the maximum of these numbers, make those absolute, and then I will subtract off what the position is in that particular period, and then add 1. So that position 1 becomes 8, position 2 becomes 7, and so on. What that will do is if I copy that down, is it reverses the order. Do you see now how 4, 18, 5, 15, etc. And this is another trick I'm going to need for my example. So I'm going to use index with this clever little trick for swapping things around with the SumProduct function. If this isn't making much sense, don't worry. Let's go back to our example, apply it, and you'll see exactly where I'm coming from. So here I am again, back at my more sophisticated monthly example. And what I want to do is I'm going to apply these percentages, the 40, the 25, the 15, the 10, the 5%, but I want to put them in reverse order. Let me explain why. You see, this 40 here is calculated as 100 times 40. In the next period, it's going to be 100 times 25 and so on. So let's have a look how this 40 is made up here. This 40 is simply 100 times 40. This 105 here is made up of a 25 and an 80. Well, how's that worked out? Well, that's 100 times 25, which is 25, and 200 times 40 is 80. Gotcha. In this period, the 185 is a combination of 15 plus 50 plus 120, which is 100 times 15 is 15. it's 200 times 25 is 50, and 300 times 40 is 120. Now, I've got no way of modelling that nice and simply, but if I swap these percentages round so that I've got 0, 0, 0, and I've got the percentages going the other way, if I had the percentages going in reverse order, then in this period here, 100 times, this one would be 100 times 40, but in these two, I'd be having 100 and 200, and the 25 and the 40 would be swapped round. Well, I could just use the sum product function, because it'd be 100 times 25 and 200 times 40. And when I've got 3 periods, if I had the 15 at the beginning, the 25 in the middle, and the 40 at the end, then it would be the sum product of these three with these three. And that's the idea. We swap the cash receipt profile around. So I'm going to use that trick with the index function to get that. So I'm going to go equals index. Now, if you open up our file and you see an @ symbol with the index here, that's just because I am using Office 365 and there are dynamic range names, and it puts this @ symbol to mean use it the old way. So if you see it in there, don't worry about @ symbols if you're opening up this file afterwards. So I'm going to go in here and take my percentages, which is J15 to U15. I'm going to make that absolute. So let's put that in like this. And then I'm going to do the trick that I did to reverse the order again, the maximum, and I'll just use the counter that's down here so you can reference it, row 46. And again, that's J46 to U46 made absolute, close brackets, minus the counter for this period, which would be $46, and then you have to add 1 back. And that would be it, close brackets, and that will give me a percentage that when I go through, it's just put the percentages in reverse order. Now, this is a much more complex calculation, calculating the sales here, very, very difficult, equals back here, here's my sales revenue, and copy that through. Hopefully that one's a bit more straightforward. And then, as I say, it's just simply, in the first period, it's going to be 100 times 40, and in the second period, it's going to be these two, with the sum product of those two. In the third period, it's going to be those three, with the sum product of those three, and so on, and so on, and so on. You see? So I just write a sum product formula. So equals sum product. And then I'm going to need offset functions to extend the range. So you can see how offset's really quite a useful function here. And I'm going to start off with anchoring my percentage in the final period, because I'm going to then be coming to the left. I don't want to actually move any rows or columns. The height is still going to remain as 1, and the width is going to be minus the period number J40. So in the first period I only want a width of 1, second I want a width of 2, but going to the left and so on. So I'm going to put this in here, minus $46, close brackets, and that's going to give me my first one, and then I'm going to multiply that by the offset of the other value, which is going to be J49, which again needs to be completely anchored. I don't want to move any rows or columns, but I do want to get to the height. Again, that's going to be 1, and the width is this time going to be just J46. Now I've just realized that shouldn't be $J46, that should be $46. If I had a brain, I'd be dangerous. Then I go close brackets, and then I need another one in here. And what that does when I copy it across, notice it's giving me exactly the same numbers as this one, but this will do it in 3 lines. Okay, I've got a blank row, whereas this one is going to do it in however many rows I've got periods. You see, so that's why it's more efficient. I'm not saying it's so easy to understand, but it's a nice, neat trick if you get your head around it. Now, I need to put all the actual calculations together. So my opening debtors is going to be, well, if it's the first period, J56 equals 1. That's going to be nothing. Otherwise, it's going to be the previous period's closing balance. Copy that across. And notice how I always copy the period across first, but just in case I make a mistake, because sometimes formulas are very similar. And if I actually have an error in one, I may have an error in many, and I've got to correct lots of calculations. So I like to do each one individually. My sales in my period is simply going back to J13 again. So rather than scroll up, I'm just going to type in equals J13 and copy it across rather than have to keep going back. My bad debts written off, I've already got in here. My bad debts is going to be equals minus. Had it up here, we'll have to scroll up here to J20. negate that. So we'll take that and copy that across. And my cash receipts are going to be equal to minus, got this already, row 51. We use this one. And because I've done it this way, it's going to be nice and easy to calculate my closing debtors, as it's just going to be the sum of the above, all equals. And that gives me my control account that I can then use to populate my financial statements. So what would happen here is, in this case, I've got 5 rows in my control account. So I've got 4 calculations to put in. The sales in the period would go into the income statement. The bad debts written off would be an expense, also for the income statement. Cash receipts would be a positive number for the cash flow statement, and the closing debtors will be my actual accounts receivable on the balance sheet. And that would be it. I've got an even more complex calculation, and I can do it either the depreciation method or what's called the reverse ticker, the counter that goes in reverse order. And I have got my control account, so I can put together my 3-way integrated financial statements. Simple. You can see, therefore, there are alternatives to the standard formula. Obviously, use the standard formula when the days receivable or days payable is less than or equal to the number of days in the period, because it's the simplest. The other ways are harder, and use that offset function, which hopefully you'll find, yeah, that's pretty cool. And if you knew it already, I apologize, but I don't know what everybody knows. But it's going to be important because cash is queen. As I said earlier, it is so paramount in the current uncertain times that we model accurately. Everybody knows how to do P&L calculations, but they make such a dog's breakfast sometimes of the cash. Okay, I'm conscious I've gone way over an hour, but hopefully it's been useful and you've got the files to play with. If you have any questions or anything, as I say, here's the contact details. My details obviously on the right. I'm based in Melbourne, Australia, although as I say, I have been in Africa before and I'd love to come back again at some point. And we also have an office in Sydney, and we've also got satellite offices in London and New York, but nothing in Nigeria yet, but gets us lots of work, and we'll certainly set up an office if you want. Anyway, if you've enjoyed this session, my name's Liam Bastick. If you didn't, my name's Tim Heng. And I'm going to end the recorded part now. I will be around for questions sort of online. We've just decided to record this video all in one go, but the formal video is going to actually finish at this point. So thanks very much for listening. Hope you found it useful. And yeah, any questions?
Yeah. So, thank you for staying to the end. And as you know, we already took the questions ahead, so don't ask me any questions. I won't be able to answer your question. And you made it to the end. We need to give you an award. This is a session where, you know, at some point I was looking at the people in the session and beginning to do a countdown. Okay, one has left, one more has left. Maybe by the time we get to the end, it will be just me. But thank you for staying true. I know towards the end, it was a bit meatier, even for me. I was struggling a bit to follow along with some of the advanced methods he used. But the good thing is the session is recorded. The material is also, he has given us, someone was asking me if the material I sent is the same for all the different sessions he did. I think so, because he gave us only one material that has many sheets. And I've been looking at the name of the file he's been working with. It's that same file. So yes, all what he did today are in that Excel file. So thank you very much. It's longer than 1 hour. I need to let you go rest. So thanks for joining. And I need to especially thank Madam Ndeye. She's my boss. She's my big boss. If you've checked my LinkedIn profile and you see that I say I still work with them. I don't know, she's not been giving me much work to do recently. Brightmore Capital, she's the one who is the lead partner. You know, she's the founder. She's doing amazing things. Thank you, Igwe. Thank you. Hey, Ogasaka, I see you again. Thank you, everybody. Some familiar, Monsieur Anthony. And yeah, so it's a pleasure. I really appreciate your staying to the end. And from your feedback, you can always let me know your feedback. You know, if there's any aspects you think maybe we should tell him to maybe just do leader aspect for us. I can tell him he seems like a very approachable person, even though he's a very big name in the industry. I don't know anybody else with a higher, maybe the other lady we brought, Madame Danielle, but I think he has been in it more than her. Well, I can't say. Both of them are big wigs in that space. So it's a pleasure to have him. If you have anything you want me to pass across to him, questions or feedback or suggestions, especially for further sessions, I will pass it to him. So thank you very much and have a nice rest of the day. Bye. Au revoir.